So consumers will substitute away from companies that are weaker in ESG to companies that are stronger in ESG.
Companies that are stronger in ESG cannot charge a higher price per unit, but they get more sales because just people buy more of their products. We've seen consumers now showing a lot more interest in, how the product is made, where the product is made, how the company, treats its employees, how the company treats the environment, how the company treats the community. But ultimately, what we actually think is driving this stock price differential is really the sense that some investors say we no longer wish to hold in our portfolios shares of companies that have no women at the top. There is no evidence that performance is worse. So if there is no evidence that performance is any worse, how can we justify the fact that given that women make up half of the world population, at the top 5 executives, because that's what we look at, the highest paid 5 executives in the organization, how is it possible that there's not a single woman there? The companies that perform better on environmental and social dimensions, do they actually sell more products? Do customers, do consumers actually care about the environmental and social performance of the companies? And indeed, we find that they do.
Hi, I'm Chris Caldwell, and welcome to Season 3 of Conversations on Climate. Professor Servaes, thank you so much for taking the time to come and talk to us in the Heritage Room here at our home, London Business School.
Great, no, my pleasure.
Wonderful. Well, today we're here to talk about really interesting, you're into really interesting work at the intersection of ESG, governance and finance. You've got a great knack of finding the data to test interesting questions like real world natural experiments that happen. But before we start to dig into your work in particular, I'd like to get a little bit of a feel for your heritage, your background, whatever. And one thing that was really interesting is that academia is typically a pretty solitary life. People tend to be working on their own in a dark room somewhere, but you seem to be partnering. Like most of your research seems to be with close partners and close relations you developed over decades.
But in that sense, academia is not as lonely as you may well think. Because the very few projects these days are sole authored, and the number of authors is in fact increasing over time. Used to be 2, used to be sort of max, now 3, 4. Now you see articles with even 5 or 6 co-authors. So it is a collaborative effort, and I think it's not quite as lonely as people may think. So.
Okay. And within you drove the wish to be collaborating, and also interestingly, because your first papers weren't particularly about ESG.
No.
How did your common bond across kind of ESG and CSR kind of evolve?
Yeah, no. I started. When I started working in the early 1990s, and neither the term ESG or CSR, for that matter, was talked about a lot at the time. So I started doing work on corporate governance and corporate control. So in that sense, I did work on the G part of ESG, but people never put it together. So I did a bunch of work on an M&A, on corporate diversification, which was a very hot topic at the time. Why do we see these diversified structures and companies splitting up? But when you then think about sort of corporate governance and the drivers of value creation, then I think studying what we used to call CSR at the time sort of became a natural extension, really. And when I started working on that, maybe 10, 15 years ago, at least in the finance area, there was very little work on CSR being done. And I really felt that that was an area that was sort of ready to receive a lot more attention. And that's when I started delving into it. And while I've still kept going on my other types of projects as well, looking at a variety of other topics, I've sort of evolved doing a little bit more on ESG and CSR as such. And when I started working on it, I certainly thought it was an important topic and that the interest would grow on the topic. Otherwise, I wouldn't have tackled it in the first place. But I certainly could never have imagined how big it became in some sense and how important it is now, both, of course, within the academic field, but also just globally, of course. I mean, it permeates, permeates government, it permeates, NGOs, and of course it permeates business and business decisions and investment decisions, throughout the world now.
So one of the biggest themes that you've been working on, as you said, is the driving of value. Like, how do you drive value in a firm, and how do you value? Like, what are the intrinsic parts that leads to the valuation of a firm? And one of them, of course, are consumers. It's you and me. It's our own buying decisions. And tell us a little bit about what the humble barcode can tell us about ESG.
Well, I mean, the interesting thing is, as you say, we're still trying to find out exactly how ESG performance from a company's part actually translates, or could possibly translate into, profits and ultimately value creation. And the various channels are still not very well understood. And so in this latest project that you're referring to, we were able to get this very detailed barcode level sales data in the U.S. essentially at the store level. So you can look at various stores that are selling various products, and then you can compare almost identical products, very narrow, but one product sold by a company that does very well on ESG and another company that doesn't do so well. And so you can really compare in a very narrow setting these two products, removing everything else. Where the product is sold, you can hold that constant. Exactly the type of product, the time when it is sold, you can hold all that constant and have a very close apples to apples comparison. And that's what we do in our research. Now, importantly, we remove the G element because that's kind of the old governance part. And the way I see governance is as the relation between the firm and its shareholders, while E&S, environmental and social performance, is really about the relation between the firm and its stakeholders. And I think it's that latter part that we are more interested in, because the G is old. I was doing governance work in the 1990s. That's sort of an old part. Of course, it's important to control for the governance when you make these comparisons. But so in this particular piece of work, we always focus on environmental and social performance. And so what we are indeed, and so you have millions of observations. We have this data at the weekly level. We have this data on sales of individual products in various counties in the US. And so when we make this comparison, we can essentially see, do we find that the companies that perform better on environmental and social dimensions, do they actually sell more products? Do customers, do consumers actually care about the environmental and social performance of the companies? And indeed, we find that they do. And so, if you increase your environmental and social performance by what we say one standard deviation, so you move a little bit outside of the average, you find that sales go up by almost 9% of that product in a given country at a given point in time. So it's a substantial effect. And then, I can expand on this if you would like. We do a variety of other tests to see which types of consumers and in which settings this work. For example, we also want to investigate whether these effects are stronger in those counties where there are more Democrat versus Republican voters. And we find that that's the case. So, and you can sort of tie that back perhaps to, whether people that are inclined to vote Democrat, whether they have, different preferences than those who are inclined to vote Republican. We also look at education, and we also look at income. And we also find that, in general, there is a stronger relation between the environmental and social performance of the company and its effect on sales in those counties where people have higher average incomes, for example. So you can really narrow it down to the county level and look really at the demographics of the customers, because not all customers are going to, think the same way about this environmental and social performance. And then we also find that what matters is not only how you perform, but also how your competitor performs. So if we hold your environmental and social performance constant, if your competitors perform better, your sales also decline. So it's really that the difference between you and sort of your competitors that matters.
Interesting. And that 8%, like that's a strikingly large number. How does that, and you say that you can break it down by demographics, by state, by education, whatever. So 8% is presumably an average. Where's the variation? Are there places where it might go negative, or is it always a positive, at least zero?
We haven't looked in more detail than just specific demographics. So the relation is always positive, but depending on the demographics, as I just said, it could be bigger or smaller, but we certainly never found it to go negative. Maybe one other interesting point to mention is we also look at quantity versus price, right? So if your sales are higher, they might be higher because you sell more or more units, or because you charge a higher price. And so the entire effect is due to the units you sell, not to the price. So suggesting that once you start changing the price, that still seems to be a place where consumers don't want to go, perhaps. We're not 100% sure, but that's at least in our setting, we don't find any evidence that they can charge a higher price for the product. They just ship more products in those areas.
So consumers will substitute away from companies that are weaker in ESG to companies that are stronger in ESG.
That's exactly what we find. But the companies that are stronger in ESG cannot charge a higher price per unit, but they get more sales because just people buy more of their products.
Seems like a good enough reason to do it to me.
So
are we near enough? So like 8% is clearly like it's a material size, very statistically significant. You also caution in your research that not everyone agrees with this. Like, is this like not all academic research kind of supports this finding? How robust are your findings?
No, I think in our setting, certainly when you look at the product level, the results are very robust. So I believe in that quite strongly. The one thing that, of course, you have to keep in mind is this does not mean that a company should take our evidence and say, well, I just need to do more on environmental and social performance because that's necessarily the right thing for me, because it's also costly from an organization, and we don't say anything about that, so we don't take a stand on that. So we by no means saying that companies sort of have gotten it wrong and necessarily need to do more, but all we can say is if you do more, this is the result you're likely to see at the sales level. Now you need to figure out as a company how much it costs to do more, what the efforts are that you need to make to do more, and then decide whether it's worth making that trade-off or not. And some companies have obviously decided that is what they want to do. Other companies, maybe don't want to do it. But at the very least, our results give you some indication of the upside. This is what there is on the table. Now, why am I not doing it? Well, maybe because it costs too much. But if you don't know how much is on the table, how much there is to gain, then it's much more difficult to assess whether you would do it in the first place. And as you well know, one of the big issues that companies often struggle with is to think about what the benefits are of improving your environmental and social performance, because some of these benefits may be very long dated, they may be more intangible, may be more difficult to really assess. And so in that sense, I think our findings speak to certainly a potential benefit on the revenue side.
For sure. And are we getting closer to a kind of consensual tipping point where consensus is saying that is supporting this position?
Well, I think consensus is clearly saying that you need to do something on the environmental and social field. Otherwise, today's consumer is not going to be willing to buy your product. So I think people will generally agree with that. But of course, we also have to keep in mind, just like with any other investment, right? The way I see this environmental and social performance as an investment that you make. Just like you buy physical capital, just like you hire people, just like you do R&D, you also invest in this environmental and social performance. And as with every investment, at some point, the marginal benefit equals the marginal cost. More cannot always be better. There has to be a point at which the marginal benefits decline. And so, as we ratchet up our environmental and social performance, at some point, the consumer says, look, they're already very high, they don't need to necessarily do any more. But given that we find that, this competitive dynamic matters, certainly companies, there has been a ratcheting up on environmental and social performance, But that's normal given that we've seen consumers now showing a lot more interest in, how the product is made, where the product is made, how the company, treats its employees, how the company treats the environment, how the company treats the community. So I think it's just normal that you see companies doing more on that front. And I think everybody believes, just like, most companies should make some capital investments and hire some, we need to do something on that front, and how much we need to do has clearly moved up over time as attitudes of consumers have changed. So
that's really interesting. And so it kind of implies that a competition effect will be promoting kind of a race to higher standards across as two companies to compete for this 8%. 8% is like, it's a material number of sales.
No, it's a substantial effect. Of course, this is measured across companies, not within a company, And so for one company to move up could be very costly, Those companies that are higher, they have more sales than the companies that are lower. But for a company to move from here to there, the investment might just be too high, and it might just not be worth it.
And so you wrote a similar enough paper kind of in 2013, albeit with the lens of kind of consumer awareness. How has your views of this topic using the lens of consumer awareness changed over the 10 years?
Well, this was sort of my really first venture working on what people then very much called CSR and not ESG, but of course the same thing, it's environmental and social performance broadly seen. So that was my first venture into the topic, and while there was actually at the time a substantial literature on this in the strategy area, in sort of the finance field, there, not that much work had been done. And so there we didn't have this detailed sales data. We just looked at the valuation of companies, trying to see whether at all better CSR performance would show up in profits and would show up in valuation. But there we actually made a relatively simple point, which is, and that of course also ties into our later work, which is that the consumer is not going to be able to reward you for it if the consumer doesn't know about it. And so there we used advertising intensity as a metric of consumer awareness. And so we did find this positive relation between CSR and value and profits only if you had substantial advertising intensity, only if consumers knew about it. If consumers didn't know about it, the relationship was essentially flat. But what was interesting is the metric that we used at the time, and we still use today, looks both at the positive and the negative aspects of CSR or of environmental and social performance. So you can be an excellent performer, you can just be sort of zero, but you can also be negative, right? You can have, and so it's important to note that this consumer awareness cuts both ways. If they are aware of your environmental and social performance and it's good, then your valuations were higher. But if they're aware of your environmental and social performance and it's bad, then your valuations were lower, right? So it certainly cuts both ways. And now if you sort of take what we found then and you take it to today, I think the relationships are likely to be similar. But I think there is more there is more awareness as such now than there used to be. There's more information out there in general. The only issue that you have to be careful about if you just relate, say, measures of value to environmental and social performance is that you have a correlation between the two. It's more difficult to demonstrate a causal effect. Is it that value, higher valued firms do more CSR, or is it that more, firms with better CSR get higher valuation? So it's more difficult to tease out that relationship. That's what we are able to better do comparing, tortilla chips sold by two different companies, one with high environmental and social performance and one with low environmental and social performance.
Interesting. And when you say kind of advertising as a proxy for knowledge, advertising is by its nature the company's message. Did you have a look at the idea of greenwashing and the idea that maybe 10 years ago I'm sure it was less prevalent than it is today, but was that a kind of a consideration in, well, they may be saying that they're doing these things, but how sincere is that?
No. I mean that's an important point, and I should clarify that, right? We never considered advertising as sort of the mechanism to tell the market about environmental and social performance. We used advertising more as a metric of consumer awareness in general. And so that doesn't mean, I mean, now I think we see more companies kind of advertising their environmental and social credentials. But if you actually go back 10 and 15 years, companies were just advertising their products. So, you know, people didn't think that much about greenwashing when we started originally doing this research, because, you know, people didn't feel like they had to greenwash, because companies didn't even think that this would, you know, show up in the consumer's mind. So in that sense, it was more of a cleaner experiment. But so when we looked at advertising, we didn't look at specific advertising on environmental and social issues. We just looked at advertising as a potential metric for, you know, broader consumer awareness. And it's just, you know, if I've seen a refrigerator advertised on TV, I might more likely then make the link to the company and think about, oh, you know, this company, you know, am I aware of what it's doing, etc. While if this is a company I've never heard of, I mean, it's just not going to show up in, you know, I can't reward its environmental and social performance.
Mm-hmm. Okay. But well, how do you draw the line then between just awareness of, you know, someone who's telling me that there's a fantastic refrigerator, or someone who's telling me it's a fantastic refrigerator, but it was made by child labor in you know, underdeveloped part of the world? Well,
but so that's the thing. You find out this is a fantastic refrigerator. You are aware of the company, and then you start digging and saying, well, what is the company actually doing? You know, what is its environmental and social performance really like? Mm-hmm. But if I don't even hear about the company, I'm not going to dig into what it's actually doing. And then I can't reward or punish, you know, the company for being good or for being bad. That's the link.
Cool. Well, that kind of leads us nicely on to the next point, which is the child labour used to make this fridge. Consumers are clearly a very important part of this picture, but another really important part of the picture are investors. Investor attitude, particularly for larger and listed companies. One of like your great gifts that makes your research so compelling is you find really interesting natural experiments out there, and one of them, looking at this issue, was the Me Too movement. How do you go about trying to measure something like sexism, which kind of thrives on the implicitness and deniability?
Yeah, no, it's an important topic, obviously, and you know, when I mean Me Too happened, I mean, at least our contention, and I think we've shown that is indeed the case. I think, you know, Me Too was really a case where investor awareness was really raised. It was really a quite dramatic change in sort of investors' awareness of what is tolerable in organizations and what is not tolerable in organizations, and you know Harvey Weinstein and then the Me Too movement really brought home the fact that this is not just about, you know, a producer in Hollywood. You know, that was the Harvey Weinstein part, but the Me Too part, you know, was really much broader and suggested that indeed, you know, sexism or misogyny is actually quite prevalent in a lot of organizations, and so you know it is, you know, quite amazing that there are still many firms where the C-suite is sort of all male, and you would not necessarily expect that, given that women make up half of the world population. You know, it's sort of funny to see that there are many organizations where there are no women at the top at all. And so our goal was to use this Me Too movement to see whether investors really, you know, attached value to having a corporate culture that is not sexist. Initially, we just looked at the top 5 executives, and we looked at organizations where there was at least one woman among the top 5 executives versus organizations where there were no women among the top 5 executives. And we're sort of arguing that if there are no women, that these organizations are more likely to have a sexist culture. That you know, it's a proxy. That doesn't mean if there are no women that this is for sure a sexist organization. We don't say that, but it is a proxy after all. And we try to see whether investors around this, you know, Me Too movement happening revalued firms based on whether they had women at the top or not. And that's exactly what we find. We find essentially an increase in the value of companies that had women at the top, and a decline in value of companies that didn't have women at the top. And the difference between the two is maybe about 1.3% over that period. And you might think that that's a small effect, but of course this applies to every single company. This is not one company announcing a scandal. This is, we looked at the S&P 1500, so these are the 1500 largest companies in the US. If you take, 1.3% valuation difference, that's an enormous effect. I think for the average company, it amounts to more than $200 million in value difference between the two. So we find that there is this difference in value. And then we start exploring more, why exactly, there is this difference in value. Because it could be related to, a number of effects. For example, people could think that if there are only men at the top, this company is going to be more likely to be sued now, right? After Me Too, but we don't find any evidence of that, for example. Some people tell a story saying, well, what's going to happen is you only have men at the top. The environment, the changes in the circumstances will now force this company to hire women, but this company cannot find women. Because they are not available, qualified women are not available. And as a result, these companies are going to now be forced to hire women that are not qualified. This is going to reduce the performance, and that's what's driving this. But we don't find that either. We find that first, they are actually able to hire women, because this is another thing the Me Too movement did. If you just draw a graph of fraction of women in executive positions pre and post Me Too, there's of course, this was going up anyway. But after Me Too, it jumped up. So they are able to hire women. Even actually in industries where there are very few women, they're able to hire women. Even you can split the US in sexism by state. And even in the most sexist states, they're still able to hire women. And importantly, performance does not deteriorate at all. So the argument, because this is kind of the old boys club argument. Well, we're perfect at leading this organization. We don't need any women, they're not qualified, and so let's just keep doing what we're doing, because if we're hiring women, performance is just going to get worse. And that simply is not the case. We find that they hire women and performance does not get worse, does not get worse at all. It's exactly the same. And so there are a number of these other mechanisms we test, but ultimately what we actually think is driving this stock price differential is really the sense that some investors say we no longer wish to hold in our portfolios shares of companies that have no women at the top. It just doesn't seem to be the right thing. So this speaks to what we call the investor kind of preference idea. So the investors do not only care about cash flows per se, but they also care about other aspects of the firm. And of course, that's exactly where a lot of this ESG literature is going. We're going to look at other aspects of the company, and we're going to value that in and of itself. And so as a result, we're going to put more firms in our portfolio that have women at the top and fewer firms in our portfolio that don't have women at the top. And that's driving this. And we then relate this, for example, to institutional investors, and you see that. Institutional investors sell the firms without women, they buy the firms with women. So you really see that difference that's driving things. So what this really suggests is that kind of changes in societal attitudes towards women actually translate now into the demand by investors and into share prices. So we think that that's quite a significant change. And maybe the last point I'll make about this, which is quite interesting, if you then divide investors into three groups based on their preferences before Me Too, so based on whether they already held portfolios that were higher on ESG, you find that most of this effect is coming from the lowest third. The firms that were not the institutional investors that were not interested in ESG, those are the ones now who kind of wake up to this, and those are the ones who change their portfolio holdings the most. The firms that were already high ESG, they in some sense they had already seen the light and expressed their preferences already before Me Too. They didn't need Me Too to change, but it's the weaker ones, where really you find the strongest difference.
That's interesting. So, and do you think that's because it's a fundamental shift in attitude, or do you think it's a risk management, or do you think it's they just see that there are now benefits of having a diverse board?
No, so it's really not about benefits per se. Performance isn't any better. It's no worse, but performance is in some sense the same whether you have women at the top or you don't have women at the top. So the idea that we need to have women at the top because somehow performance is better, there's actually very little evidence on that. And some people have pointed that out, saying, so there's no point having women. But the way we should interpret this is exactly the other way around. There is no evidence that performance is worse. So if there is no evidence that performance is any worse, how can we justify the fact that given that women make up half of the world population, at the top 5 executives, because that's what we look at, the highest paid 5 executives in the organization, how is it possible that there's not a single woman there? And so if performance doesn't deteriorate, we may as well do the right thing and have women at the top. But so it's also not about risk. We don't find any change in lawsuit. We look at bond prices, for example, to see whether there is any indication of risk. So it's not about risk. It's not about cash flows. It is about the preferences of investors. That's the one explanation that survives, where investors just say, look, I'm willing to pay a higher price for these firms that have women at the top, and I'm willing to, I'm only willing to hold the shares of firms without women at the top at a lower price, because I'm not interested anymore in my portfolio. Mm. So in that sense, if you want to call it, say, attitude, that's the right thing. It's really societal preferences for something that are now translating into corporate value through the preferences of investors, and mainly. The ones we can measure are institutional investors, because for them we have great data on they have to tell you every quarter which shares they hold, so we can see what happens before versus after Me Too. Mm.
Okay, so post Me Too, there's been a bit of a backlash, which I guess was inevitable. The kind of cancel culture type of conversations happening now. But this research seems to suggest that there are long-term enduring benefits to scandals. Is that a fair take?
Well, certainly the Me Too was a scandal as such. The benefit, society benefited from that because it raised awareness. We could, of course, argue, did we really need the Me Too movement before realizing that this was an issue? But
apparently we did.
But we did. certainly we do find that change. There's a clear break in any patterns. There's other things that we looked at. You can do. There are these world value surveys and general societal surveys that look at attitudes towards women, and there too we really find a break in the pattern after Me Too. So in that sense, if there is any upside from that does seem to be the upside. Maybe as you point out, maybe it's sad that we needed this event to get our act together, but at least it did make a substantial difference.
Yeah. Well, it's a step in the right direction. But that's all it is. It's a long path, and we need to get a lot better at that. But
none of what we say, of course, says that you should just hire women indiscriminately and hire for its own reason. You should hire high quality individuals. The only thing we're saying is apparently the firms are able to hire high-quality individuals that happen to be women, and they do just as well as when they were hiring high-quality individuals that were not women. So why wouldn't you, in some sense, right? And that's the point that we are stressing.
It's a good point, well made.
So because we thought, right? Initially we thought, well, maybe they end up hiring women, and you will see performance deteriorate, and then they're proven right. They're proven right in the sense that they're just not there. The qualified women are not there. We can't hire them. But it is just not what the data say.
Yeah. I have read some papers that suggest the more higher diversity in the boards increases performance. But you didn't find that, did you?
Well, so it's a very good question. There are a couple of points to this. So first, we also look at the board. And we don't find any results on the board to begin with, right? So this is not about the board. This is about, women in leadership positions. And of course, we're not saying that the board is not important, but but when it comes to leadership in an organization, the market is looking at, are women in leadership positions, not are they just on boards. The other thing you of course see is that there is now a lot more female representation on boards, because that has been the entire focus. But we've kind of forgotten the leadership of the organization. And so now, if there are a few women on the board, we've ticked the boxes and we're okay, and we can continue having no women at the top at all, leading the organization. And that doesn't seem to be right either. Now, the second part, this is of course not my research, but I think in general, the results on board diversity and performance are relatively weak. This goes again to correlation versus causation. And I think there is very little causal evidence to actually suggest that sort of diversity, at least in terms of gender, that diversity in terms of gender on the board makes a huge difference. Now, the one thing that we do have to keep in mind is that the largest institutional investors in the world have, over the last couple of years, decided that they will always vote against the board if there are no women there at all. And if they don't, if they're going to vote against it, or if investors are going to start selling firms that have no women on the board, then you're going to get exactly the same effect, of course, as the one we found for women in leadership positions. But that's still, I think, up for research.
Yeah, really interesting distinction there between board and highest paid. Your highest paid you cannot mess with. That's the top five.
Right. I mean, these are in decision-making positions, because there is, of course, always a worry. I'm not saying that that's the case, but there is sometimes, a worry that some women are on the board more as a token, and that's of course not helpful either. Now, people have studied then, well, are they, heads of board committees, etc., to see whether they have more decision-making authority. But ultimately, you're not going to have, a female CFO as a token. Mm-hmm. You're going to make sure that these are qualified individuals. And as I said, we find that they hire them. They seem to be qualified, because we don't find anything in terms of operating performance that would suggest that things deteriorate.
Okay, perfect. Now, all of these behaviors we've been talking about so far, and sustainability, gender inequality, all kind of add up to something called social capital, as you talk about it, which is a bit of it's a funny term. It kind of marries something that's quite woolly with something that's really quite hard in kind of accountancy terms. Could you kind of define social capital for us?
Well, I mean, I think social capital is really the set of relationships that the firm has built with all its stakeholders over time, that help the firm, perhaps not always, but perhaps in certain circumstances. Right? If you think about, Econ 101, your basic economics course, you take some capital, you take some labor, you put it together, that's the firm, and you look at what its output is like. But we've realized, of course, that, in addition to sort of capital and labor, there is, intellectual capital, for example, your R&D. People sometimes talk about organizational capital, the relationships between the people, and that's also how I kind of see social capital. It's the broad set of relationships between various stakeholders in the organization and the strength of those relationships, and that is as important, I believe, as these other elements of capital. And so in our earlier work on CSR/ESG, we argued that measuring environmental and social performance is really a good way of measuring that social capital in organization, because it really measures the strength of the relationship between the firm and its stakeholders, and that then this comes really from sociology almost. Some of these terms, people talk about reciprocity, which is just I've been good to you as my worker, now I need help, well, you'll be good to me, and that capital is important. And in some of the research we did, we found that particularly during the global financial crisis, this social capital was really important for firms.
Great. Great. Interesting, you draw a distinction between kind of investment into kind of tangible assets and in social capital. We understand investment in tangible assets. You buy something, you buy a machine or whatever, and you use it. How should we think about investments in social capital?
Yeah, no. Well, one way of measuring it is looking to see exactly what the firm does on the environmental and social aspect. So we thought that CSR was a proxy, not necessarily the only proxy, but was as a proxy in some sense to measure this social capital in the organization. But there may be other things. For example, one could imagine, and people have studied this, I haven't, but one could imagine measuring the social capital as the relationships that board members have in other organizations, right? So if your board members are well connected with other people, that also defines some social capital. So there are various other ways we could think of measuring this. CSR is just one of them. For us, it was just a convenient one to study in some sense.
Okay, yeah. Great. So we've talked about consumers and investors so far. One we haven't talked about, which is relevant here, are bondholders. The most kind of hard-nosed of investors. You understand kind of consumers and investors both have some sort of link to performance in the company. They've got some sort of motivation for the company to perform. It's less so with bondholders. They're more kind of, they look more at kind of risk profiles rather than anything else. Do you see, do lenders ultimately care about these things?
Yeah, I mean, I've done myself less research on this. I've done some, but I think in general, lenders do care, and I think for two reasons. One reason lenders care is because it may actually be, some of these things may just turn out to be risk factors, right? If you invest in a company that's dirty, then over time, maybe that company will get into more trouble, or consumers won't buy from it, and so it could just be deemed to be a risk factor as such. In addition, and this is a complementary explanation, so it could also be going on, is that the investors in the banks or in the lenders or in the institutions that are holding the bonds are now also, are now becoming so conscious that they're almost imposing, right, on the banks or on the institutions that hold the bonds. They're imposing some ESG constraints on them. And so, I think for a lot of companies now, at least larger commercial loans, you have to, it also has to meet some ESG criteria almost. It's almost, if you don't, then I think you're going to have a more difficult time in getting it sold. And so just as the shareholders are maybe willing to take slightly lower return by increasing the price of firms that are doing well on environmental and social performance, I think you might well end up seeing similar things on the bond market part. It is more difficult though, because the bond market is much smaller. There are a lot fewer companies that are issuing debt, and so if you're going to then restrict yourself and stay away from some companies, you're actually going to lose out quite a bit on diversification. While in corporates or in shares, you can afford to be a little bit more restrictive because there's so many more to choose from. But I think even in the bond market, this is playing an important role. Now, the research that I have done on this was sort of limited to studying what happened during the global financial crisis, and there we find no effect of environmental and social performance on your bond yields, on your bond spreads, except during the global financial crisis. It was clear that during the global financial crisis, those firms that did better on environmental and social performance, those firms that had better social capital, in other words, their bond spreads didn't jump up quite as much. I mean, everybody's bond spreads, of course, jumped up during the global financial crisis, but their bond spreads didn't jump up quite as much. And these firms were actually still able to access capital. They were able to access capital on better terms. They were able to access capital for longer during that period. So it is clear that during that particular crisis, those companies that had built up this social capital through environmental and social performance were able to borrow at lower rates. And then we sort of follow that up, and we do see that before firms go to bond markets, they also improve their environmental and social performance, because that does seem to matter in terms of the the spreads that they get on their particular bonds. And then we looked specifically, of course, why that's the case. Why are bond investors willing to lend at lower yields during the global financial crisis. And our argument is sort of that if managers cares about all their stakeholders, they're not going to go do crazy things during a crisis period. If there is a crisis in the firm or in the economy in general, it's no longer about we're all in it together. It's getting the biggest piece of the pie, and that might mean that the firms might make decisions that are not in the interest of bondholders, but those might also not be in the interest of other stakeholders. They might just be in the interest of shareholders. And what you see is that those firms that have more social capital, they're less likely to, for example, increase risk, etc., which would not be good for bondholders, but which would also not be good for the other stakeholders. And they don't do that because they build up that social capital that says, I'm not going to do that to you. That's this implicit contract that we already have. So you find that those firms where risk-taking, the ability to take risk and to kind of take money away from the bondholders was the biggest, those firms are exactly the ones whose spreads went up less relative to other companies if they had higher social capital during the crisis.
That's really interesting because the natural response in moments of crisis is to be cutting the so-called soft stuff such as this, but like your research suggests that's absolutely the worst thing you can be doing, because you'll end up being punished by bondholders who need to be paying more for any kind of future debts.
No, absolutely, that's exactly right.
Interesting. So how should firms be thinking about this, about building up kind of social crisis? It feels like it's an insurance policy. I think you described insurance policy yourself, where you need to be paying a bit of a premium during the good times to be able to sail through a crisis in a better state than you would otherwise be.
I think that's the best way of describing it. It's almost, buying insurance against, some negative events in as such. And in fact, sort of coming full circle to what we were talking about, initially, it could be insurance, against things that happen in the firm, but it could be also insurance against what happens in general. And so if we go back to what we were talking about initially, on whether consumers are more likely to buy products of high ESG and low ESG firms. Another test that we conduct in that paper is we look at natural and environmental disasters that are occurring not where you do the sales but close by. And what you see is that if an environmental or natural disaster occurs close by where you are selling, then consumers become more aware of the company's environmental and social performance. So you asked about this 8% effect. Well, the effect becomes bigger when you are located close to an area where environmental and natural disasters happen, because that's when consumers say, wait a minute, are these firms the ones that are taking care of the environment? Are these the firms that are taking care of, of the community, etc., or not? And so they pay more attention. Sadly, perhaps it does dissipate. You find that the effect is there for a couple of quarters, but then they go back to normal. So then they go back to the 8% effect, But if something bad happens close by, there is a hurricane in the next county, suddenly I'm going to pay more attention in this county to the environmental or social performance of companies that sell products in this county. So I haven't been hurt by the hurricane, but I've just seen it, I'm more aware of it. And so, now that this is sort of another way of coming back to awareness. Right? In other research, we talked about advertising as a metric of awareness. This is just, oh my goodness, this stuff is happening. Let me pay some attention to what the company is doing to mitigate these issues.
Yeah, that's also really interesting, especially considering, taking into climate change for a minute, we're going to have increasing amounts of ever-increasing amounts of extreme weather events. So that kind of implies that companies will be moving further, will be pushed towards more environmental ESG measures.
No, certainly that's certainly the case. As you know, right, in terms of climate risk, there's sort of three elements to consider, right? One is just the direct effect of climate change on the operations of the firm, because I'm affected by hurricanes or I'm affected by bad weather, and there, of course, when these things hit you, you want to be protected. The other part, of course, is just a transition risk, right? Which is maybe my products are no longer suitable for this environment, so that transition risks hits different firms, very differently. And then I guess the third part is the regulatory risk, right? Which is, well, what regulations are they going to impose on me? But all of these, of course, are could be material for companies, and they're all relevant, all relevant to worry about. And I think EE&S, environmental and social efforts, can help, perhaps mitigate the worst of that. But of course, when it comes to kind of investor preferences, you I think do see, and there is some evidence out there now that that to hold certain companies, firms do need to provide higher required rates of return. There this and that is not, I think, just about expected negative cash flows. It is just about the fact that people don't want to hold necessarily those shares anymore in their portfolio. Just like when we talked about the Weinstein effect, they don't want to hold shares in their portfolio that have all men at the top. They also don't want to hold shares in their portfolio of a company that that's considered dirty or brown, and to do so they're going to require a premium. So that does lead to something that people maybe don't expect or seems counterintuitive, but it is not, which is that if you hold a portfolio of dirty firms, you're probably going to get higher rates of return than if you hold a portfolio of clean firms. Because the dirty firms' prices have been depressed, and there is an extra required rate of return added to their discount rate for people to be willing to hold those firms. If you are then willing to do that, you are going to get rewarded for that risk. It doesn't sound pretty, but that's of course the consequence. If we drive the prices of green firms up and we drive the prices of brown, dirty firms down, that's what we're going to get.
Yeah, you need to have a pretty strong stomach for risk, though. Yeah, at some
well,
point,
yes, I mean, but that's you're absolutely right. But that's the risk-reward trade-off, right? So you're going to be taking more risk. Yeah. You are going to get higher returns for it, and there is not mine, but there's certainly research out there that there's been a carbon premium already for the last decade or so. That high carbon firms, may have outperformed already over the last decade, which is not, people. It doesn't square exactly with people's thinking. But,
be interesting to see whether that is changing post COP28, where finally there's been an acceptance we need to be transitioning away, phase down, phase out, transitioning away. It all means the same thing from fossil fuels. And then you had the German representative saying, well, this means that we can no longer be investing in new fossil fuels because they'll end up being stranded assets. So if that premium essentially goes away, because the understanding is, well, it may look cheap now on the basis of dividend returns, but the actual capital value of this has got a very finite life. So.
Yeah, but of course, if investors are taking all that into account already, that will already depress the price so much that it's still going to pay off for a while. I mean, somebody of course has to hold the assets, right? And we do have to be a little bit careful that we don't almost outlaw holding the assets, because then there has to be some capital that we still need some fossil fuels. We can't just cut to zero now, right? So we do need to make sure that that the transition sort of happens in an orderly fashion.
And there's some good arguments to be made that you have investors who care, who are sitting there and engaging, as opposed to them being in the hands of people who generally don't care about any of this stuff. And the investment movement, it's a complicated subject, but there's certainly a strong argument to be made that you're better off having a voice at the table and trying to make
right. Yeah, this is voice versus exit debate, of course, right? And there's certainly some people are arguing that voice might be better than exit.
But going back to your research on the Great Financial Crisis. Now, you might have, Mark Carney and others have been talking quite a lot recently about how the climate crisis will result in a kind of fundamental repricing of assets, which will make the Great Financial Crisis look like child's play. What does your research suggest to listen to firms out there who are looking to try and protect themselves against an oncoming financial crisis if that's that type of level?
Yeah, I mean, I'm not sure I'm not sure it should be put that dramatically.
No, my words.
I think that. I think investors are smart and are pretty good at predicting things. Now, sometimes things fall apart. We had the dot-com bubble burst and we had the global financial crisis, so there's clearly some bubbles. But to say that there's now a bubble in prices because we haven't thought enough about climate risk, I'm not sure I necessarily I agree with that. I think a lot of that risk is indeed already priced in, I think. If not, there's a lot of, that's the issue with, the pricing of assets. If you really don't think that this is priced in, there's a lot of money for you to be made to fix mispricing, right? And that's why, opportunities for mispricing are not around that much, because there's a lot of smart money that is going to try and fix these problems. So I'm certainly not a doomsday speaker saying, that this is going to be quite as devastating, perhaps, as some people might think. Now, of course, I'm a professor of finance and professor of corporate governance. I'm not a climate scientist, and perhaps the people in the markets haven't talked enough to the climate scientists, and perhaps there is some massive unpriced risk. But I think I'm more optimistic that we are moving in the right direction, and the transition is well underway. Of course, we do need, as with all these things, ultimately there's a lot of externalities here, and when it comes to externalities, of course we need some intervention, we need some regulation to sort out these externalities. I think governments at least are doing the right things. Now, maybe one thing you can argue is that making pledges for 2050 is very easy to do today because they don't have to bear the consequences. But at least we are getting somewhere, I think.
But we're not getting there fast enough.
That's potentially the case. But again, I have to be very careful as to what I know and what I don't know, of course.
I will tell you, we're not getting there fast enough from this chair. I can tell that. So the market for distressed assets, something you've done quite a lot of work on, because it kind of fits into this general conversation. The idea of fire sales, the idea of distressed assets itself, it kind of conjures up kind of something that is quite negative. Like there's negative connotations. Well, particularly the word stress. There's something that there's not a positive thing. But your research suggests we should learn to love the fire sale. Could you tell us that?
Well, of course it depends on from whose perspective we're talking about, right? But there certainly has, before we started doing our research, there was certainly a notion that fire sales were, very negative because, firms had to sell quickly, right? That's sort of the definition of a fire sale for a variety of reasons. They had to sell quickly. And there was certainly some research out there that in fire sales, not surprisingly, assets are sold at relatively low valuations. And so people saw that as a very negative thing. But that's of course only half the trade. You also have to look at the one that's doing the buying, and as long as the best buyers are not sidelined because they have some problems, as long as the best buyers can still be out there, then yes, maybe they take advantage of the fire sale by offering a low price. But if they then benefit from that, as long as the asset, for sort of economic efficiency reasons, as long as the asset ends up in good use, then we're okay. And that's sort of what we found in our research. We found that the sellers do pretty badly in a sense, but the buyers actually do very well compared to regular mergers, right? We compare fire sales to regular sales, but the total gains are actually not that different. And so it's a transfer of wealth. It's bad if you're a seller. But it's not the case that these assets then linger in the hands of buyers that are not quite as productive. That's certainly what we didn't find. Now, if you then, we did not write this article specifically to talk about sort of stranded assets or distressed assets due to the climate transition. But if you kind of want to then take these results and kind of apply it to that situation where you see firms that do have stranded assets, there is no doubt that if they want to get rid of those and put them in the hands of others, if that's a fire sale, I have no doubt at least that that's going to be done at prices that are not quite as attractive But as long as the buyers then, can still operate those assets efficiently, from an economic efficiency perspective, that may not be the end of the world. Now, there's also another part to this that might be interesting. If it is the case that firm share prices are depressed because some investors do not want to hold these particular firms because of their asset composition, and they just don't value that, right? This is beyond risk and return. It's just what they want to hold and what they don't want to hold. If that is the case, then you may well see the entire firm being depressed in value because of a specific asset. If you then get rid of that distressed asset, even at a discount in some sense to somebody else, that's the negative part. If now the remaining firm does no longer suffer from that discount due to those assets that were dirty and that investors didn't want to hold, that could actually be positive for the rest of the firm, right? And so that's certainly something to consider. I haven't really seen much research on this that sort of looks at what happens to the relative valuation of the companies that get rid of their dirty asset. Does the valuation of what's left then go up because investors are just now more likely to enjoy holding those assets? You got to be very careful that there's the risk and return part. We've been doing that for 70, 80 years, and there is sort of this other part where other preferences now show up into what investors want to hold. And so, I think that's certainly an interesting angle to explore, but it wouldn't surprise me, given my other research, that this is indeed the case.
No, it's interesting. I think particularly in climate, I understand exactly where you're coming from in the kind of the firm, like one firm buys, one firm sells. It's a transfer of value. There's no destruction of value. It is neither created nor destroyed. It remains the same. It's just in one hand to the other. But in the worlds of climate, where the most vulnerable nations are the nations who have done least to cause climate change, the ones who are least able to afford it, and they will be the ones who are suffering the greatest economic consequences of climate change. There's a power imbalance there. How do you see the power dynamic in this?
Well, I mean, you have to be careful, of course, that those countries where there are more dirty assets, they don't necessarily have to sell, right? I wouldn't say that it's a fire sale as such, right? They can hold on to the assets and they can also try to improve themselves, partly, of course, through support from other countries, from governments who are helping with their development budget, etc. So I don't think, you can see the glass sort of half full or half empty. I don't think we have to be necessarily negative that these assets are going to kind of be picked up then by.
But it's not even kind of dirty assets or clean assets. It's all assets. It's just any asset that happens to be sitting in a climate vulnerable part of the world that is being affected. It's there will be the large, powerful, wealthy state or country or company that can come in and pick up these assets.
True, I think, but countries can to some extent. There's still no fire sale, so we can pick them up, but you can always walk away, right? And that's the difference between a regular sale and a fire sale, right? With a regular sale, if they're not willing to pay the price, you can say, I'm not selling, and I don't need to sell because I'm not going to go bust if I don't sell. While with a fire sale, if you don't sell, you might go bankrupt. And so I think we obviously need to help, and through development budgets, etc. I think part of that is certainly other governments that need to help out. Now are we doing enough? Again, I don't want to veer too far from what I know and what I don't know. Of course, governments are limited in what they in the developed world are limited in what they can do, because through the global financial crisis and COVID, government debt has just risen everywhere, and so there is less of a limit and less appetite to help out. In the end, what we have to realize is that by helping out, we are protecting our own future, because pollution has no borders. But that requires, of course, some some good foresights of politicians, and politicians thinking thinking very long term, which is not their best skill.
Absolutely, yeah. And that kind of leads us to kind of a really interesting other kind of implication of all this, and it's the idea of the bailout. And the pros and cons of governments stepping in and bailing out particular companies or even entire industries. Now, one good example in the climate space is, don't know if you've seen it, but Florida have recently mandated, the government, the state of Florida has recently said to insurance companies that they must be insuring homes that are in flood zones. Now, there's a certain moral hazard attached to that, and there's also a certain ultimately, everyone will end up paying for that. It's a socialization of that cost, but and insurance companies are leaving en masse if they're not prepared to do this. So, what are the implications of this research on the ideas of bailouts? Like, should they be done? Like, should in the climate world, quite naturally, quite literally, should nature take its course?
I mean, it's a tough one, right? So the whole free market thinking would say that government should try to stay away from bailouts unless there are sort of systemic problems that get caused when a bailout doesn't take place, right? And so that's the question you have to ask. Now, you rightly can ask that in Florida as well. I mean, do we have to provide insurance? I mean, the question is what price, right? Because there probably is a price at which you would provide insurance even if the government didn't tell you to do it. It's just that people might not be able to afford it. So there probably is some price regulation associated with this. I mean, I wonder whether if this is a problem that the government wants to deal with, then maybe the government should underwrite the insurance rather than forcing insurance companies in some way to get involved with that. I mean, if they think that there is an externality there that they want to address, I think they can certainly do that. I think it's of course not nice if you build a house somewhere 20, 30 years ago and it looked totally safe, and now and now it's no longer the case. It would not be nice and fair to now no longer be able to insure it and use what for most people and lose what for most people is probably their most important asset. But I'd rather think that the government could underwrite that and could through some policies rather than starting to force insurance companies to get involved, because then you're distorting the insurance market in general. So.
You are, but ultimately there's a very high proportion of the population that lives on the coast, and also you then need to throw in people who live within welfare zones. So you'd end up, I think the statistics are something like 25%, 30% of the population of America are impacted by one or the other. So it's a really difficult thing to socialize.
No. I mean that is tough. I mean, at some point, unfortunately, I think some people are going to get hurt because nobody can afford to pay the full cost of this, of course.
Yeah, and it's entirely unfair on the other 70% to be doing this. Yeah, so at what point do you feel that it makes sense for us to let nature take its course? At what point do you think that we should be looking at kind of social, particularly in the context of climate, because it is something I can understand in the banking system, where you think, contagion and things may, if you can stop this one particular bank falling, then it reduces the prospect of contagion to other banks. But in something that is far more, a system is itself malfunctioning. Are bailouts ever going to be a good idea in the climate space?
I think it's a difficult case to make. I very much think maybe at the margin in some limited circumstances, yes. Otherwise, I think it's unaffordable to do so. And I think, I think some people unfortunately are going to get hit. And as you say, you might think that that's very sad, but if we socialize that cost and it gets imposed on everybody else, and you have to ask about the fairness in that case as well.
Fair enough. Okay, so just if we normally kind of wrap up with one last question. It's asking for a piece of advice. And here, from all of your work over the years and looking at at crises and looking at particularly kind of the great financial crisis, what's your top tip for how we can set ourselves up to be one of the winners in the next crisis?
Well, I mean, it's a very broad question, but I think, investing in social capital might be something we don't think about necessarily. But I think what we've shown in previous crises, at least in the global financial crisis, at least, is that social capital does pay off. Mm-hmm. So make sure that you build trust among all the stakeholders in the organization, and I think that can make a substantial difference.
Okay, brilliant. Well, thank you very much, Henri.
My pleasure.
It was a real pleasure.
So,
thank you very much for joining us on that conversation. We hope that you enjoyed it. We hope that you learned something. If you did enjoy it, please feel free to leave a 5-star review and to subscribe to any of our channels, and we'll be sure to keep you updated on future productions. These are conversations that you just can't afford to miss.